The article I decided to do for my final project was Interest Rates Are Low, but Loans Are Harder to Get. Here's Why by the New York Times. It came out earlier this year in January, so it still relates to what's going on with our current economic situation. The basis of the article primarily is covering the relationship between current interest rates and how they're consequently affecting credit negatively. For those of you that don't know, interest rates are very low right now, and it's actually negatively affecting the market right now with receiving loans. The article starts with a couple in Zebulon, South Carolina, that are both public school teachers with reliable income. Those are reliable jobs. Yet they're still having to have a higher credit score than they would have before the pandemic, and they're having to put up more of a down payment, a higher percentage than they would have before. And the article dives into why this is. Mortgages are really tough in general to get. Usually it's around 20% to pre-approve if I'm not wrong. But lenders right now have really tightened their standards in a few separate ways. The first way that you'll see credit being tightened is with credit cards. Lots of even like outside of banks. I know that some bank accounts have had maximums for their credit cards be 10,000, and now they're down to 8,000 limits. Or banks are even starting to close dormant accounts just because the current economic state is too risky. Back to that heftier down payments, pretty much across the board, you're going to have to come up with more money now than you would have before the pandemic, just because there's higher requirements, and with that there's also more documentation. It's honestly just more of a pain to go out and get a loan. They want to know the withdrawals, every ins and outs of how they're going to get their money. Borrowers have been able to pause mortgages, halt student loans, and delay paying their bills. This is pretty much the problem of why these lenders are struggling to give out the same amount of loans that they usually would. Since that people aren't having to, like, their cash outflows aren't what they usually would be without the pandemic, that it's, with things being halted and stuff, they really don't know how much money or income they have because they're not paying it. And especially with these forms of the government support, and there being with the stimulus and things like that, and things being halted, it's just really tough for these lenders to give out these loans. And that's why they're increasing their requirements, their documentation. They're just really tightening up, trying to not make sure they're losing any money. This has even gotten into weird loans. The article covered jumbo mortgages, which is for like big mansions or extra large mortgages. You used to be able to get one at Wells Fargo in California, it says, at 10% down for the down payment, but now it's doubled to 20% for a jumbo mortgage. So for the people that are buying these extra large houses, that's increased as well. But the largest thing that take away from this article and credit in general, or financing house, is that the current economic effects are unavoidable with the stimulus that seems nice up front, but it's still not as easy to get long-term credit like a loan, or even your credit score has to be higher, so you have to really pay attention to how you're using that and making your payments on time. So either way, with or without the stimulus, it's interest rates are really low right now, but it's not necessarily helping the financing for a house or receiving another type of loan.